So now let's proceed. So let me just quickly summarize what we thought about yesterday. So we thought about, I told you all about price action, basic market structure, whereby price move in three major directions: price moving uptrend, downtrend, and sideways. So for an uptrend, we see where you see a situation whereby price is creating a series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, until we see a major change of character, a change of trend. Same thing goes for a downtrend. To see price heading lower, creating series of lower high, lower low, lower high, lower low, lower high, lower low, until we see a change of trend whereby price is going to shift from an uptrend, from a downtrend to an uptrend. You understand? And I made mention something about change of character. Change of character is a situation whereby price change, price reverse from downtrend to an uptrend. You understand me? So whereby a situation whereby you hear that okay, this particular market has had a shift of structure. You can either call it shift of structure or change of character. You understand? Like right here now, as you can see, this price was actually heading up. It was going up until it gets to this point whereby buyers have actually lost control of this market. Then sellers start coming in and they start pushing the market downwards. You understand? So just like a question that was being asked yesterday about when is the best time to enter the market for an uptrend and for a downtrend, and I said I'm going to actually make a video. I'm going to actually elaborate more on that today. So on uptrend, you want to fully utilize the movement of the market. You want to make sure price actually you're catching this retracement, because as price creates a higher high, there is always a retracement. You can never see a scenario whereby price can never just move upward like this. It's not possible for price to just keep on going up. No, no, no. There's always retracement. There's always retracement, because in the financial market we have both buyers and sellers. You understand me? They are both buyers and sellers. So as buyers are trying to bring the market upward, sellers are also trying to bring the market down. So it's just like a battle between buyers and sellers. Then whosoever have the highest momentum at that particular period of time is going to be in charge of the market. You understand me? So on uptrend, you want to actually make sure you catch this retracement, because if you're looking for an entry, if you want to trade on an uptrend market, you'll be waiting for this retracement for price to get down so that you can actually have a very good entry. So let me show you an example in the live chat. Okay, I think there's an example right here. Let me move lower. Let me move to the 30-minute time frame. Let me clear this part so that you all can see this more clearly. Well, let me move to another chart. Okay, why is loading? Let's head back to this XAUSD chart. I think I'm having kind of network issues. So anyways, by mere looking at this chart, you can tell it's an uptrend. By mere looking at it, you can actually tell this is an uptrend, because we see a situation whereby price creates a low, a high, a higher low, higher high, higher low. You see another higher high here, right here, higher low, and price just keeps on moving up. So in a situation whereby you want to catch a trade from this particular uptrend in an uptrend market, you want to be looking for a demand zone. You want to be looking for a demand zone. And what's a demand zone? A demand zone is a zone whereby there are a lot of buying pressures. You understand? A demand zone, I think I should write this down for you. A demand zone So I think it's a typical example of a demand zone. Let me enlarge it. So this is a demand zone. A demand zone is a zone that contains buying pressure or a point where buyers are waiting to enter the market from. So on an uptrend market, we are anticipating buyers because buyers are actually waiting to enter this particular price. They are trying to look for buying opportunities. So for a demand zone now, like right here now, we have a demand zone here. Let me mark out all the whole demand zone we have here so you all can see whereby price is going to have retracement. So after we see this major impulsive move to this point here, we see there is a retracement here. And after this retracement, you can see that there's a demand zone here. There's a demand zone here. And how you can identify a demand zone in a chart? A demand zone is for a demand, demand is buy, we have demand and supply. For a demand zone is the last bearish candle before a bullish move. You understand? A demand zone is the last bearish candle before the bullish move. So I don't know if you all can see this. Let me enlarge the chart. So I don't know if you all can see this bearish candle. This bearish candle at this point here. So this bearish candle, this is what I actually pick as my demand zone. And price actually came there. It went back up. So price will always seek to retrace to a demand zone before it's going to continue movement upward. You get my point? So the same thing goes for a downtrend. Let me see, because I think I have a typical example of a downtrend on volatility 10 index. So that's for an uptrend. Then for a downtrend now, I think this chart now is going to be more clear and more visible. So now by me looking at this chart now, you could tell it's a downtrend because it's creating series of lower low, lower high, lower low, lower high. From this point now, you see price come here. Okay, see price come here, create this low, lower high. Why is this called a lower high? Because it's lower than this previous high. This high is lower than this previous high. That's why it's called a lower high. Then price came here, lower low. It's called lower low because this low is lower than this previous low. Then we see lower high. Price came here, lower low, lower high. Then it just keeps on going up. This is the basic market structure. But here now we see that price actually came up here, create a high that is higher than this previous high here. I'm going to talk about this shortly now. Then price still head downward, creates a lower low again. It just keeps on going like that. So now let me show you all a typical example of a supply zone, because in an uptrend market, you want to be looking for buy and you are looking for retracement to the demand zone. I want you all to understand me. And for a downtrend, you're looking for a retracement to the supply zone. Just like demand zone is a zone that contains a lot of buying pressures, supply zone is a zone that contains selling pressure that sellers are waiting to sell the market from. You understand me? We have demand and supply. Demand is for buy, supply is for sell. So whereby you hear someone say, okay, price went into the supply zone. No, that supply zone is like for a sell entry. or the person is looking for sell opportunities in the market. So right here now, you see price came here before it went down, like this retracement after price have this major impulsive move from here. You see this retracement up here to this point now. Now the zone that price actually reacts from before having this another impulsive move down here is a supply zone. The supply zone, and the zone is this last green candle, this last green candle before this impulsive move to the downside. You have this zone is our supply zone. This is our supply zone. So price will always react from the supply zone on a downtrend market. You understand me? Price will always react from the supply zone on a downtrend market during a retracement. You understand? So for the person that was asking yesterday about when is the best time to buy, this is the best time. Just note, before the major impulsive move, the last for a downtrend market, the last bullish candle, the last green candle before the move downwards is your supply zone. That candle is what you're going to mark out as a supply zone. Then let's look for a typical example again. Okay, now we have price have this impulsive move all the way down here. Then it have a retracement. I'm coming. Okay. My voice is cracking. Please, can you guys hear me very well? Okay, let me continue. So from this point now, we want to look for the last bullish candle before price move downwards here. Then you're going to notice this is the last, okay, this is the last bullish candle before price actually starts diminishing downwards here. So you take this zone, mark it out as your supply zone. Then you see that price will always come back and retest this zone before going downwards. You know, we don't want to enter the market blindly. You want to make sure you fully utilize every bit of opportunity that price gave you. So you can't just enter a trade blindly. You have to be patient. So like when you see that price actually heading lower here, like this now, you want to make sure you wait. You can't just enter the trade randomly. You can't just place trade randomly. You have to make sure you wait for price to have that retracement before you enter, because you now so entering at that price retracement is going to give you an edge. It's going to give you more confirmation, and you're going to have good risk to reward ratio. You understand me? So at this point now, this green candle here, okay, wait, let's look. I think this green candle here automatically becomes our next supply zone. This green candle, this bullish candle here. I will consider that price actually just came and tapped into it, just tested without even having any drawdown upward, then it head downwards. So price will always seek to take retracement to your supply zone before it's going to head downwards. So if you're looking for an entry opportunity on a downtrend market, make sure you always look out for your supply zones to trade, because you're only looking for sell opportunity. So that's it for basic market structure. So now let's move on. Let's move on. Now, so today we're going to be talking about advanced market structure. Advanced market structure. So let me just clear everything down here and let's just start all over again. So today's topic will be advanced market structure. This is just like a summary on yesterday's topic. Yesterday we'll talk about basic market structure. Please mute yourself. Your mic is on. Please mute yourself. Mute yourself. I think let me check. I think someone mic is still on. His mic is still on. Okay. All right. So today now we'll be talking about advanced market structure. This is what you want to actually pay attention to. So just like we have basic market structure, whereby I describe the markets move in three major directions, which is uptrend, downtrend, and sideways. Sideways is just a situation whereby price is just consolidating. Price, we are not saying price creates a higher high or a higher low. Price is just moving in a major level without having any breakouts. So that's for sideways markets. That's not really important because that's the market you want to stay away from. So advanced market structure, just like it seems easy when I said on uptrend, is whereby price move like this, create higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. But the truth is that price does not always move like this. Price does not always move like this, because if price move like this now, you all be billionaires, because the market makers, this market is not actually crafted for us to make money off it. The banks, the financial banks, they want to take our money, they want to take money from retail traders, so they are not going to design the market in a way that we are going to easily make money off from the market, you understand? So price movement is not always as easy as this, it's more complex than this. So price can actually create series of higher highs, higher low, but it's not going to be as clear as this, as I was describing it in the basic market structure. I'm just giving you all the like the background of how price move, but price does not always move like that. It's very rare for you to see a situation or a market whereby price is just moving very easy, go up, come back, retrace, go up, come back, retrace. No. The price movement is more complex than this. Maybe you can see a situation whereby price will move like this, so to create a high, low, a high, then price will come back and take out liquidity from this previous low and still go up again, break this high. You see price can still come again, do as if you want to actually go up, come down again, and then still head up again like this. So you understand my point? So price movement is not always like this because they don't want you all to make money from the market easily, you understand? So this is just the foundation of price movement. This one is just the basic, but you won't see price movement be as easy as this. It's more complex because they don't want you to make money off the market. So in advanced market structure, there's what we call liquidity. And liquidity, what is liquidity? Liquidity is what moves the market. Liquidity is money. I don't know if you all have heard about liquidity before. Liquidity is money. Liquidity is money. And without money, this market will not move. Without buyers and sellers bringing their money in and out, this market is going to remain stagnant. So price seeks liquidity. Liquidity is what fuels the market. Just like for most of us here now that have cars, before you can actually drive your car, you need to put fuel in the car before that car can actually move. So that's just the same thing with this forex market. Liquidity is what moves the market. Liquidity is money. So every highs and low that you see in this particular market, every highs and lows contains liquidity. So now, let's say for a normal price movement, for an uptrend market like this, that price actually creates half break of structure. Why is this loading now? Why is this loading? Just type it. Then you see break of structure. After this break of structure, you see price go up, come back. There's actually liquidity at this low. I don't know, for most of you, you're supposed to be having your writing materials because you need to write most of everything I'm saying downwards for future reference. So every highs and low in the market contains liquidity. Every high you see in the market, every freaking high and low you see is liquidity. This high you see here is liquidity. As you can see here now, so price came to this high and it swept liquidity off this high now before it came back down, and then it continued its movement. Every high and low If the liquidity will not be taken out now, it will be taken out in the future. Liquidity must surely be taken out of the market. Unfortunately, this is not a liquidity class, but for an advanced market structure, you need to know this major price movement. So, just like I said, every highs and low contain liquidity. Right here now, we have break of structure. Let me clone this. We have another break of structure here too. You also have another break of structure here too. And then please always ask question anywhere you are confused or you need me to elaborate more on there. So I know most of you will be like, okay, why is price actually coming down lower to this point? Because let me say you're actually on a buy trade, and the price is actually, let me say you enter at this point now. You enter at this point, and maybe you've targeted your swing structure. This is just an illustration. I'll still move to the live chart for more clarity. Let me say you've targeted your swing structure to be at this point. Okay, wait, let me just start afresh for more clarity. Let me say this is your swing structure now. Okay. Yes. So this is how complex price movement is. For an advanced market structure, price, the first rules, there are some certain rules that governs advanced market structure. The first rule of an advanced market structure is that there must be a sweep of liquidity. There must be a sweep. You understand me? So first thing you want to see is there must be a sweep of liquidity. So right here now, let me say in the starting of a downtrend market, you are looking for a buy opportunity. There must be a sweep. Right here now, see price create this low, then price came back here, sweep liquidity up this low. After that sweep, what is going to validate that price is actually heading upward is you want to see a break of structure. You want to see a break of structure. Then after you've seen that break of structure is what signals that price have actually changed direction to an uptrend, from a downtrend to an uptrend. You understand me? This is what signals that price have changed direction from an uptrend, from a downtrend to an uptrend. So after you see that price has swept liquidity from a particular low, what you want to see is a break of structure. After that break of structure, first of all, this point now, we'll call it our point A. Let me highlight this now as our point A. This is our point A. Then after this point, after price have given us our point A, which is sweep of liquidity, what we want to see next is break of structure. After this break of structure, price is going to give us what we call point B. It's going to give us point B. This point B is what we call structural liquidity. This is what we call structural liquidity. Then admit. Okay, it's not just joining. So this point B now is what we call structural liquidity. This is what I do every day. This is what I use for my entry every day. This point B now, we call it structural liquidity. You highlight it now. And then this, your target to be your point C. Point C might just be, this is just how you can actually analyze your swing structure. So now this is your point B. This is your point B. Then the target is your swing high or when you see that this where price is actually going to head to, that's going to be your point C. So now if you're looking for an entry, on this kind of market, one of the rules of point B is that point B is like your enemy. Point B must be taken out. This point B must be taken out because this is the lowest low before point A, before market swept liquidity of this low here. This is what we call structural liquidity. So this point B now, price must always take it out. So after price can just keep on heading, moving forward, but the moment price will actually come back to this point B and take out this structural liquidity, these are the rules of advanced market structure. Price will always come back to take out this point B, this structural liquidity. Then after this, that's when you'll be looking for your entry. You'll be looking for your entry at your demand zone, because this is actually for a buy setup. You'll be looking for your entry at a demand zone that is close to your break of structure. You understand? If you all check the group, most of the setup I caught yesterday, it was just this setup. This is the setup. This is like the normal. This is what I do every day. This is what I look for every day in the market. The precision I get from this particular setup is actually epic. You get my point? So for an advanced market structure, price will always come and take out liquidity. So we have different forms of liquidity. We have inducement, we have structural liquidity, we have transactional liquidity, but I'm going to break it down in a detailed form when we're treating liquidity class. But for an advanced market structure, this is just how price movement is. You can't see a situation whereby price will just be going upward like this. It's not done that way. The market makers will not allow price to be as easy as this, so we cannot just make money off it. So now let me move to the charts. Let me move to synthetic.
Excuse me, please, can you come again?
Okay, from where?
From the entry, you were saying something about MB.
Okay, from
like
the
it's not a
entry
good
now.
place to start marketing.
No. B now must be taken out because B is a structural liquidity, and one of the rules of an advanced market structure is that B must be taken out. B must always be taken out. You understand me? B must be taken out. Because after you see that price have actually come to this point now, this point B, because your entry is always close to point B. You take your entry from a breaker block. I'm going to also tell you all that in the future. We're just starting this class not quite long ago. So B is close to your entry. After that liquidity comes your POI, your point of interest, whereby you have your demand zone close to that point. So let me move to a live chart now for more clarity. So I think the trade I got yesterday was from is it VIX 75? Oh my god, I pray my chart layout is still saved. No. No, this is not my. I don't know what's wrong with this volatility. It is actually the setup I was anticipating to. But let me just break it down. Let me analyze it from the beginning again. So I got this particular entry from the 5-minute time frame on VIX 75. Okay, yes. This is setup here. Impact kill. Okay. So now this is the live chart now. First of all, once you enter a chart, you want to analyze your swing structure. You want to make sure you have precision on your swing structure. Precision is like where the market is, point A, and where the market is heading to, which is point C. You understand, Cole? So this is my point. Okay, I think I did not highlight this out, but this is actually my point C. That's which is my target, my profit target, where I'm targeting price to head lower to. You understand? This is my point C. So point A, let me head to the 10-minute time frame, because I think this is too tiny. Okay. Okay, now, just like I told you all in that illustration, first of all, now we need to see a sweep of liquidity. A sweep of liquidity. This is the sweep right here. You see that price actually came lower and sweep this low down here. You understand? You saw this low that was swept here before price actually came up here, gave us our transactional liquidity, then came down and gave us this structural liquidity that was here, point B. This point A. Oh gosh. I'm trying to make it more bigger. But I hope you all can see it, Sha. So this is point A. Point A, mind you, point A is a protected low. This becomes a protected low. Protected low means that price will not, there is nothing that is going to make price to head lower to this. So after price have actually, you've seen that price has swept liquidity. It came up here, gave us our transactional liquidity here. It head down and gave us this, our point B, which is our structural liquidity down here. See this candle here, down here is our structural liquidity. And after price gave us this structural, let me take this out. Let me take this tools out so you guys can see it more clearly. Okay. So now you see that price actually came to this zone here and gave us our point B, which is our structural liquidity after the sweep. Then the other rows I told you, there must be a break of structure. This is the break of structure here. As you can see, this price was, this market was on a downtrend. This was a downtrend market before. To see next is break of structure. Now we've seen our break of structure. 1, 2. Multiple break of structure is going to make that entry more valid. You understand? Then what you want to see next is a change of character, a shift, whereby price broke out from the previous lower high, create another higher high. As you all can see now, this high here that I say is higher than this previous high. You understand? So now this already has given us the confirmation that okay, this trade is going to be a valid setup. You understand? Then now for the entry, like I said, your entry is going to be your demand zone. Your entry is going to be your demand zone, yes. So for a demand zone, your demand zone is going to be the last bearish candle before the major movement. You understand? That's for a demand, that's for a buy setup, because right here we're looking for buying opportunities. So right here now, I think I got my demand zone from a 5-minute time frame. Because and one of the entry reasons is that your demand zone, your entry must always be on the 5-minute time frame. Must always be on the 5-minute time frame. You understand? So right here now, this is the demand zone here on the 5-minute time frame. Like I said, the last bearish candle, that's for a bullish move for an uptrend market. The last bearish candle will be your demand zone. That's what you're going to take out. So just as you all see, I highlighted here. As I highlighted here, I mark it out here. I draw it out to this point, and then boom, price came out here. Take out point B, this structural liquidity here. Price took it out. And then after I took it, what do we see next? See price tapping to this demand zone. You can see the precision. Price tapping to this demand zone here, and then it went up. So after it went up here, I also got another entry reason. Just like I told you, when you see that price is actually having break of structure, because there was actually a break of structure here. Because I already know price will go to the upside. So there's after I see this break of structure here, what am I looking for? I'm looking for retracement. I'm looking for re-entry to continue with this trade. You understand? So I wait for price. I look for another demand zone again along this point here. I look for another demand zone. Okay, sorry, this is actually an inverted scale. This was a sell trade, but I just turn it down so you guys can understand. So this green candle is my supply zone, but based on on a bullish movement, it's a demand zone. As you can see right here, it was initially like this. It was a sell trade, you understand? But it was like this. So I have to turn it upside down so you'll understand. So this was actually a sell trade. So as you can see, this is my supply zone, which is this green candle. I don't know if I can continue like this. I just want you all to understand. That's why I switch it backwards. So after I point out this zone to be my supply zone because it's a sell, so I'm looking for sell. And right here, this is it green candle that was my supply zone. This is what I picked for my entry. This green candle, not the red one. I just remembered now that it's actually a sell trade, and I actually switch it upside down. So immediately price came up here to this point here. After I've seen this break of structure, I'm waiting for retracement. So I mark out this zone immediately. As price came here, the next thing we want to be looking for is candlestick confirmation. You cannot just enter trade randomly. You have to wait for candlestick confirmation because right now we are looking for a very more precise entry, not just 1:5, not just normal 1:3 risk to reward. We're looking for like 1:20. Like this setup now was actually 1:20 risk to reward ratio, whereby if you have stack here now, so like if I entered here, if any of you must have taken this trade when I dropped the signal yesterday, if you have entered there, if you're risking 10,000 naira, you're risking 10k, your profit target, my profit target was just this point. Price just hit it and then it's reverse. My profit target is 23 risks to reward, and price actually smashed it, which is about 10k to 230k. So I'm not looking for setup like 1:5 because when I got my entry from here, see this 3 candlestick formation. Let me not jump it. So let me try to highlight it here so you'll understand. So the 3 candlestick formation is like this. This for a sell. 2, 3. This is not well defined, but let me just use this for this example. How's this? Okay. So now let me just use this to illustrate. Then now this will be the red candle. No, sorry, this is supposed to be a green candle. Let me just flip it backward. Let me just say these are red candles. This is a green candle. This is a red candle. Then this is another red candle again. You understand? So the 3 candlestick formation is that after I say that price have gotten to this point, then this last candle might either be a doji candle, a shooting star, a pin bar, or a hammer candle. I don't know if you all don't know about this. You need to go back and learn about candlestick formation because it's highly essential. You need to learn about candlestick formation, which you learn about these candlestick patterns. So it's either going to be a doji candle. So after price came here, this is my first candlestick formation. This first green candle here is like this one here. After this one, I saw price tapped into my demand zone, my supply zone rather. After this, I not just enter immediately because I want to have a more precise entry. Then I wait for this third candlestick. I wait for the body of this candlestick to engulf, to close below this candle here. Once I see that the body of this candle, of this third candlestick formation, this third one, then I can go ahead and start. That's how I got this entry. Then your stop loss will just be above the wick of this particular candle. Above the wick of this particular candle. Then you can target your point C. So remember, I told you before you start, you can just move to either the 1 hour time frame or the 30-minute time frame and get your swing structure. You understand? So now I got my swing structure ready for the 30-minute time frame, because normally we have up to down analysis, but I don't want to actually bother myself with the previous past price action here, with what price I've done in the past. So I'm just focusing on how I can get a good entry reason from here, a good trade setup from here. So I just come here and mark out this point A, which is my protected high. It becomes my protected high. Point A is my protected high because price have already swept liquidity from this point. So I'm not actually expecting price to move down here. Anything that is going to make price to come below, to come above this point, is going to make this setup to be invalidated. You understand? So initially the setup, my stop loss was above here, but I got a re-entry at this confirmation candle here. Then your target will always be point C. So once you just open your chart, you look for your swing structure, which is the recent price action, what price is doing recently. You look for this swing structure here, and then you mark out your point A, point B, before you try looking for entry reasons. So this is just more advanced class, but as we proceed, you have more clarity on how all this is being done. You understand? So I think we're going to stop here for today. This class is pretty more longer than I expected it to be. So I think our next topic will be what's going to be? I'm coming. Stages of market structure. Yes, stages of market structure. Where I'm going to tell you about accumulation, manipulation, and distribution. So before I end this also, one thing you need to know about change of character. On uptrend, this was something I was saying yesterday, but I forgot to elaborate more on it. So in a scenario whereby price is actually heading towards the on uptrend, our price is going up, creating series of higher highs, higher low, and then you want to confirm that price have actually had change of character, because just like you see here now, after price created this okay, let me just bring another example. Let's say price is doing something like this. Please take note of this. And then, boom, see price come here, do something like this. Let me stop here. So now, based on what I've explained to you guys, you see break of structure here. See another break of structure here. See another break of structure here. Then after this break of structure, a situation whereby price failed to break this previous high, this higher high. Then what do we see next? We see price move lower and then break this previous higher low here. Then create a new lower low. This is supposed to be a change of character. right here now, it's supposed to be a shift of structure, it's supposed to be a change of character. Okay. This right here is supposed to be a change of character because price have actually broken this. Price failed to break above this previous high, and then what do we see next? See price break this previous higher low and then gives us a new lower low. So at this point now, this is our shift. This is what we call change of character. Why is this thing loading up to me? So this is a change of character. You can identify it as CH or shift. So now this is our change of character now, CH. So, but this is not actually valid because sometimes you can see a situation whereby price is going to give us this change of character, which is going to signal a reversal, meaning that price want to change from an uptrend to a downtrend, whereby we want to be seeing price start heading down lower like this, creating new lows, new higher low, lower low, higher low, lower low. This is what we expect, but this is not, this one change of character is not valid because of the advanced market structure. You might see a situation whereby price might come here now, break this low, and then go back up here. You might be, most people now will start having that bias that price have changed character. They'll now be looking for a supply zone or an order block to sell from at this point here, because they want to catch, they know that price will always retrace back so that they can catch, and then they can catch a sell setup and then continue to hold the trade as it's heading back. Why is this thing? Continue to hold the trade as it's heading back lower. You understand? But sometimes you might see a situation whereby after you've entered from this point now, let me say you've taken your buy setup, your sell setup rather. From this, let me say you highlighted you spot out your supply zone to be around like here now, and then you've entered your sell because you feel like price have had change of character. Because after change of character, what you want to be looking for is sell. That's if price was on an uptrend movement before, you want to be looking for sell trade. Then let me say after you've entered your sell position, and here now, then let me say you target the swing low here, then you might now see a scenario whereby price will just do something like this. Price might just react to that supply a little bit, then boom, hit your stop loss, take you out of the market. You understand? Price will just take you out of the market and go ahead and create this new breakout from this previous higher high and create another higher high, despite the fact that there was a change of character here. So this is what is called price manipulation. Price, just like I said earlier, price movement is more complex. Market makers will not make the market easy for you to make money. You understand? So for you to actually know a valid change of character, what you want to see is market break to markets. Okay, let me take this all right. Okay, so let me just continue from here. So you want to see that price actually break at least two higher lows. You understand? You want to see price. This is the first change of character. Price have taken out this high, create a lower low. Then what you want to see next is price break out from this point too. After I see that price have actually done something like this now, broke out from this this higher low to create another lower low here, then this is going to be a valid. After this now, you'll be looking for sell, you'll now be looking for whereby price is going to come to a supply zone along this point, because you have actually confirmed your buyers for sale. You need to have two break of structure to the downside to confirm a valid change of character. You understand? You need to have two valid break of structure to confirm a valid change of character. If not, there's what we call inducement liquidity. Inducement, a situation whereby price is just going to come here, take out liquidity off from this previous high, and then continue movement to the upside. You understand? So whereby you want to wait for price to break out from this low, come back here, create another lower low again after this low. You want to see price break out from at least two lows. This is the first one. Second one, you want to see price take out at least two lows before you start looking for sell. Sometimes this can also work. Just one change of character can work, but most at times we usually see a situation whereby price can just come and take you out, and still continue movement to the upside. So don't get fooled by the market. I think I had one entry on GDP USD. How many time frame? Let me see if I actually went to my entry. Okay. Okay. Wait. Why have not gotten to my entry? So what okay, now look at this entry I had here now. Look at this entry. What I'm trying to say. Look at, we have this lower high, another lower high again. So this entry now is an inducement. IDM is inducement. So I'm expecting price to come up and take liquidity, but I don't know that price is going to go down up the way to this point here, because when I got this entry, price was just at this point. All this price have not actually created all this movement back then. So expecting price to go up, because this is a downtrend already. As you can see, this is a downtrend. Market is heading lower. So I only want to look for sell opportunity. So this is a low. I was expecting price to do something like this. I think from this point here, I was expecting price to head up, take out liquidity from this point, and then move over to this point now and tap into my entry before heading down lower. You understand? So this is the kind of setup you want to be looking for. Like, only look for sell. But I'm going to explain to you all how to look for entries like this, all these using inducements, order block, breaker block, and so on. So I think this is going to be all for today. Tomorrow class is going to be more precise and not as complex as this. So thank you all for joining here today. So we'll talk tomorrow. We'll see tomorrow. We'll have more interesting conversations tomorrow. So please ask your questions in the group. I know most of you all will have a lot of questions to ask. Endeavor to ask them in the group. Yeah, so that will be all for today. See you tomorrow in the next class.